But moving forward and discussing a lot more stocks with Siddharth Vora. He's of course joining us from Prabhudas Leeladhar as well. Good to be speaking with you, Siddharth. Just to begin with, marking a few more stocks which are actually doing quite well. And you have Bharat Dynamics that comes to mind because that stock is, I think, trading higher right now by almost 5%. And you also have G Shipping doing well. Z Entertainment is in focus. Actually, on Z Entertainment specifically, is this a stock that you probably cover, Siddharth, or have a view on?
So from the PMS side, actually, we're not looking at Z Entertainment at all. And given that we use purely quantitative strategy for evaluating, right now, Z is not even among the top 150 ideas that is being screened by our quantitative models. So on the institutional side, we do cover it, but not on the buy side.
What have you added recently, as in not the stock price, the idea is to understand the thought process of where you're finding value and hence building up positions?
Sure. So I think the last 20, 30 days have been very, very good for the portfolio as well. Some big winners for us since the last rebalance in, say, mid-April have been Cochin Shipyard, Musgao Dock, M&M, Hindustan Aeronautics, BEL, Indigo, and Honeywell Automation. So over and above some of these ideas that I just mentioned, we also have a significant overweight in the whole metals pack. So I think the whole auto, defense, industrials and metals exposure has done really well for the portfolio.
Not only did they come out with very good set of numbers, but also the commentary last evening in the call, after almost several years, in fact, they've conducted a call of that sort. What are your thoughts on the valuations of some of these defense names, which have run up quite a lot, but do they give you good visibility and comfort even from here for next 2-3 years?
So again, our idea is to be using our quantitative models to be able to look at all these stocks, not from a lens of valuation alone, but rather a combination of valuation, growth, the quality improvement that we're seeing in their balance sheets across a cycle, along with what the sectoral trends are also showing. So we want to be invested in stocks that are from a relatively stronger sector rather than those stocks that are from a relatively weaker sector. So I think combining all these factors together definitely gives us comfort to hold some of them till our models suggest otherwise.
At least for now, holding on to those positions in some of these defense majors. In fact, the HAL management did speak with the investors yesterday. They are talking about EBITDA margin being maintained around 33%, and more importantly, the order pipeline is very strong, almost 1.6 to 1.7 lakh crore worth of order visibility that they have in the pipeline, and they're confident of consistent double-digit growth, which they managed to hit the mark 1 year prior itself. Let's listen into a slice of that commentary coming in from the management of HAL.
See, broadly, what we expect the EBITDA margins should be in the range of, on the most optimistic note, it could be somewhere around 32 to 33%, and at the minimum level, it should be not less than 29%. Because broadly, our operating profit ranges between 18% to 20%. The amount depreciation and amortization is approximately around the 5 to 7% range, and the interest income may adds up to another 6%. So this would mean that it should be somewhere around 30-31% should be our EBITDA margin. The current order book positions and with orders in the pipeline and with new orders likely to materialize in 2 to 3 year time frame, we will be able to show a consistent double-digit growth, which we will be for the next, in fact, all these orders we will be in a position to execute up to 2032. With the current visibility of orders, we will have our workload full for 2032, and we can consistently maintain this double-digit growth without any problem. And as far as the manufacturing growth is concerned, now that with the orders getting executed, the manufacturing growth definitely it has to be around 15 to 18% growth has to be there every year, and with the repair and the overall growth of around 9 to 10% growth, we will be able to sustain our growth what we have shown in the current financial year of 13% on an average, both manufacturing and repair and overall put together, we will be able to sustain that growth.
So that was the commentary on HAL. Even after the result-based up move, the stock is gaining 4% in trade. Siddharth, Indigo has recently announced their starting of the international routes. Up till now, they've been the big daddy as far as the domestic airspace is concerned, massive market share there. Plus, they've aggressively started ordering new aircraft. What do you make of the prospects for Indigo? And this is the only one which is making some decent money on in the space. Otherwise, everybody else is bleeding. Can it get further re-rated from here in next few years?
So the thing with Indigo is that we've been holding it for the last close to 6 months now. And I think the broader thesis on Indigo is obviously extremely positive demand dynamics. At a country level, we're seeing unparalleled air traffic. At the same time, a lot of weakness in competition, a lot of issues with other airline groups. And given Indigo is the best managed, most efficient airline company gaining market share out of weakening competition, I think structurally it's very, very well positioned, I would say. So I would not worry about incremental re-rating from here, given the tailwinds are very, very deep and long.
Mark a few more buzzers at the moment. Nestle is, of course, reacting to the news flow that the shareholders have rejected the royalty hike plan. So, some shareholder activism coming at play there, up around 1.5%. And in terms of the other movers right now, we do have names which are reacting to earnings otherwise as well. Z Entertainment as well as Crompton. In fact, Crompton, after that monster rally yesterday of around 16-17%, I think it's actually managed to pile on 2 to 3% today as well. Kunal, what's your view on Z Entertainment as well as Crompton? One should buy perhaps Crompton right now at 400 or stay away?
Z specifically to stay away. I think we've discussed the stock even earlier when the stock had fallen down from those 250 to 30 levels. And from there on, it's been consistently, of course, under the news flow, under a lot of selling pressure. So it doesn't make sense to buy the stock even at current levels of 140, 150 range. I think it has to show signs of stronger recovery. So it's better late, better to buy the stock late, but on confirmation that the trend has reversed rather than on anticipation and keep on holding the stock and seeing the stock drag for quite a lot of time. But Crompton could be interesting bet because after almost weeks and months of price correction, the stock has finally managed to make a comeback. Yes, the previous major swing lows for Crompton was around the 300 mark, but from there the stock has climbed up 30%. The volumes have started to look attractive only in the last few days of the price action move for Crompton. So I believe even at current levels, 400 approximately, traders could look to start buying the stock. Wait out for a mild bit of correction. If it happens to the stock, say around 380, 385, look to add for.
Well, that's the view coming in on Z as well as Crompton. But since we are talking about Z, let's listen into a slice of the conversation the management had with the investors yesterday on the con call.
Our visibility and confidence in our performance in financial year 25 and our ability to achieve the long-term aspiration of 18 to 20% EBITDA by financial year 2026 has further bolstered. In the new fiscal, all the interventions will fully play out over the next 3 to 4 months, and there will be some one-time costs in the near term. That said, a positive upswing should continue in the subsequent quarters, and we remain our visibility and confidence in our performance in financial year 25 and our ability to achieve the long-term aspiration of 18 to 20% EBITDA by financial year 2026 has further bolstered. In the new fiscal, all the interventions will fully play out over the next 3 to 4 months, and there will be some one-time costs in the near term. That said, a positive upswing should continue in the subsequent quarters, and we remain well poised to capitalize on this opportunity.
Okay, so that's the management of Z Entertainment. But in the meantime, Siddharth, there seems to be the big takeaway from this earnings season has been rural recovery, because that's something that all the managements, right from paint companies to your consumer durable companies to FMCG, have been pointing out. To play this theme and the fact that monsoon is expected to perhaps hit us on May 31st itself in Kerala, how are you churning your portfolio to make sure that it's poised to capture that rural recovery theme?
So I think we have quite an overweight on the auto pack, the domestic focused auto pack. And I think auto is, for us, the best way to play the rural recovery, given strong volumes, improvement in margins, a lot of new product launches, and a very, very solid traction to the new product launches. So I think with a good monsoon expected as well, I think names like Maruti, M&M, TVS, Bajaj Auto, Hero Moto, the entire pack is likely to be a clear beneficiary. And obviously, there is an increase in the average selling price and improvement in product mix across the entire auto chain. And I think that with the capacity expansion that all the auto majors have announced, should do much better in terms of reducing waiting period, improving execution. So we want to play it via the auto route because there is a lot of demand visibility there.
Auto ancillaries, some of the auto anch, Varick for example, Endurance Tech doing very well. Which part of the auto anch space are you playing in your portfolios?
As of now, we're not exposed to any major auto ancillaries. We are playing with the OEMs as well. We are exposed to the OEMs.
What about within auto? Have you started building a position in any of the CV players? They have been quiet. The two-wheeler and passenger have been doing well, but now the word is that second half of the year actually CV cycle will start improving. Do you have it in any form, either CV financier or CV OEM?
We have exposure to Tata Motors for the last close to 7-8 months now, but other than Tata Motors, nothing else yet. I think Tata Motors gives us a much broader play rather than just CV, but the cyclical uptick in the CV cycle also obviously benefits Tata.
Fair enough, that has quite a bit of diversified portfolio right from the luxury end to the commercial vehicles. But Delhivery is one stock which is actually coming a bit under pressure. The management did talk about some softness in the quarter gone by in the offline segment, and they also talked about their plan as far as entire e-com is concerned. Let's listen into a slice of that conversation that the management had as well, if we have that ready, because they do talk about the good performance that they have overall seen, but there was some softness as far as consumption is concerned. But you'll try and play that soundbite for you later. But for the time being, stocks which are actually doing quite well include a lot of these logistic players as well, whether it's Aegis Logistics or All Cargo Terminal. These are some of the stocks which are actually doing quite okay. Naresh, do you have any view on these names? All Cargo, Delhivery, other names as well?
So out of that, Aegis is something which I recommended before, but now Delhivery looks the interesting name. So the stock has gone sideways for the longest period. Today, the stock has corrected post a resignation of a senior management. But it has gone through a 12 to 18 month consolidation phase. After that fall of 50% in 2022-23. So at 400 to 450, the stock has been consolidating, expecting it to eventually break out and go higher. So Delhivery looks interesting from the whole pack as of now. And in the same way, Mahindra Logistics, which has gone through a sideways consolidation, is also interesting.
In particular, in fact, I wouldn't be surprised if Mahindra Logistics actually is the least performing or most underperforming stock from the overall Mahindra pack right now. What would you do with M&M? If traders have been riding on the long side at 2500 odd, is it time to book out or hold positions, Kunal?
No, I think it's definitely a hold. Ajay, it doesn't make sense to book out of the stock as of now because all the classic ingredients, the leadership quality, the price trend, the sustainability of uptrend, volumes, and the FOMO factor, frankly, because I think traders who've been investing to the likes of Tata Motors, etc., I think they would have missed major chunk of the rally for the likes of M&M. And we've seen that in the last few weeks, the move has gotten a lot more polarized for many of these auto stocks. And I think that's one of the major reasons why I would believe that the stock may not provide. So if the market gets into a corrective phase, that's a different ballgame altogether. But by itself, I would believe that M&M would continue to march up higher from current levels also. So would not suggest to book out profits, but maybe trading stop losses could be a better strategy in case if there is any kind of an advent of volatility in the markets going forward.
Okay, so that's a take coming in on M&M, but we're just speaking about Delhivery as well. That stock being down around 2.25%, though on the charts, Naresh finds it a bit interesting. Listen into a slice of what management had to say about the way forward.
Incremental margins have remained in that 40 to 50% range. And as capacity continues to get utilized, our margins will continue to go up. The important thing is as we continue to grow, we anticipate that the long range profitability of our PTL business will at worst be equivalent to other players in this market and at best will be significantly better. So, we will continue to grow. That's our priority. We've done 1.4 million metric tons of freight in this financial year, which is 30% over the previous year. We'd like to keep that kind of growth rate going. I don't anticipate pricing pressure at all. I mean, if somebody decides that they want to make no money, then obviously everybody in the industry is at risk. There's no doubt. But the question is, how long can you continue to sustain that? My view is not very long. So we don't have pricing pressure in that regard. And I should also point out, if you look at our trajectory of yield, the important thing to see really is that while we have brought yield down, we have maintained service EBITDA margins in the range that we specified, and we will continue to do that. See, I think industry growth, at least as far as we've been able to gather from our clients as well, and their appetite to sort of grow remains in that 15 to 20% range. If anything, actually, to be honest, most of our clients do believe that this will be a pretty solid year for them overall. We're being conservative and are assuming that 15 to 20% growth is kind of what we will see. And that's what we've also planned our internal operations and capacities for.
Right. So that's delivery for you. In fact, after a long while, not only the stock market movements, but there is interest coming. There were a lot of blocks also in the previous week as far as all these logistic counters are concerned. But Kunal, among wires and cables, last week we saw a big move in RR Kabel, Polycab, in fact, before that as well. And now the smaller names like Universal Cables have started moving. Can you do a chart check for us on Universal?
So I think first on the formidable two names, yes, Polycab and RR Kabel. RR Kabel was something specifically which I've been tracking very closely. Also, I think of course it has a limited price history. But then except for that one phase in the month of January or February where the stock was volatile, I think it's been a classic trending stock. So even at levels of 1730, 1750 plus where it's trading right now, it still looks attractive. Now Universal Cables, even though the stock has recovered and rallied from 450 to I think 600 plus in the last 2-3 months. The trend for the stock is still not very strong. It's it's moving up on much thinner volumes than what we require when the stocks move up on much higher volumes when they see a fresh breakout for themselves. And the sudden stop which the stock gets. So post a breakout, we expect the stock moves up high in a gradual and a steady fashion. But if it gets into a pause, which means that there are not too many buyers who are ready to buy the stock even at a breakout point, and they're waiting for the stock to maybe get into a corrective phase. So that odd pause in between for Universal Cable maybe makes the trend a bit more erratic as compared to the likes of RR Cable or maybe Polycab.
Okay, so those are the top recommendations within the cables and wires segment, but a lot of big buzzers there, and the fact that the consumer durable segment as a whole has been doing quite well in terms of earnings, whether it was Blue Star, Crompton, or even a lot of other smaller names, they've all performed quite well. So real estate as well as consumer durables and now defense, these three packs are clearly doing quite well in the trading session. But in terms of the losers today, JSW Steel is down. APL Apollo Tube is something which is coming under a bit of pressure. Kunal, yesterday, if I remember it right, you had a BDST call on JSW Steel ahead of its earnings. What would be your recommendation now on JSW Steel? Should one book out losses a bit, square off, or continue adding and average it out? What's the view?
It's definitely a hold, Nisha. So I think the result could probably have been impetus for the stock on the upside, but 1.5% down for the stock doesn't impede the near-term trend for JSW Steel. And what we are looking out for is a much more bigger trend for the stock. So we are looking out for a much more bigger breakout because the stock in the last 4-5 months has been stuck into this band of 900 as an upper end of the range and 825 to 800 broadly as a support. So we are looking out for a 100 point, 120 point of breakout for a stock like JSW Steel. So I think this could actually be a good zone where traders who missed out earlier could look to buy.
Okay, on that note, Kunal, Naresh as well as Siddharth, we let you go for now. The first session is drawing to a close. 10 o'clock is when.
If you like this video, then like, share and subscribe to ET Now.